This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
As we saw in the pro forma for TTP, many of the items in there we've already covered in previous chapters. If you haven't watched those previous chapters, will you please do so? We're going to have a bit of a recap here, but you really should have watched the adjusted profits, capital allowances chapters and the income tax section and the capital gains tax chapters in order to be able to fully understand and be able to fully comprehend what's going on in this chapter. So tax adjusted profits, as I mentioned before, very similar to unincorporated. So those two chapters are the adjusted profits chapters and the capital allowances chapters, and that will give us that. Exactly the same process. There is a slight difference. The pro forma looks exactly the same. We still adjust for depreciation, gifts, fines, non-business use, all of that. However, here again, I've already said that, haven't I? Shall I read it again? The rules discussed in Chapter 4 for unincorporated businesses are similar for incorporated and should now be revised. Okay, so you've been told 3 times now. So the main difference, there are some differences. There are no private elements of any expenses. Companies don't have private expenses. They don't drive cars. So if you've got in your Section C exam, put in your exam, Section C, a big adjustment of profits calculation, please note, is it a limited company or is it a sole trader? Because there are differences and we don't want you to make mistakes simply because you haven't read the question carefully. If it's a limited company, there are no private expenses. So drawings are irrelevant. Any salaries that you see in the question must be for employees because companies don't have salaries. No family salaries. Okay, legal fees regarding the issue of share capital is an expense only for companies as they are in capital nature. The expense is disallowed and added back in the adjustment. Okay, legal fees are allowable for patents and trademarks. Now, in the individuals, if you had a non-trade loan, it needed to be added back. Now, for individuals, that non-trade loan then goes to interest income. You have to make one more step towards that. Interest payable to HMRC is treated as non-trading. However, that is also tax relievable against interest income. Capital allowances. Basic capital allowances are exactly the same, okay? The rules you'll find there, but there's no private use, okay? And only one AIA in a group. It has to then be split between the various companies within the group. Okay, just like we did with the upper limit. Now, we do have a special, only for companies, a special enhanced capital allowance when you buy new and not second hand. So the question will tell you very clearly that it's new. So if it falls in the normal main pool, which will make sense if you watch the capital allowances lecture, there is a super and it would attract AIA. There is a super deduction, 130%. It's a first year allowance. So for every £100 you spend, there's £130 worth of first year allowance. Not cars don't qualify. Zero emissions cars will get the normal 100% first year allowance. Now, if it falls in the special rate pool, for expenditure that which falls within the special rate pool, there is a 50% first year allowance. Now, the effect of this is that the special rate pool expenditure that should firstly attract AIA as 100% AIA is better than 50% first year allowance. If it exceeds that limit, then the excess is eligible for the 50% first year allowance, and anything after that gets 6%. So I think you'd rather have 100% AIA than 50% first year allowance rather than 6%. It will become clearer when we do capital allowances question. Now, again, second hand, not eligible. And you're never going to have, there's a special note there. Disposals of assets that attracted these enhanced capital allowances have special rules that apply, and they won't be examined in your exam. Phew, thank goodness for that. Let's have a look at this illustration then that shows us how that works. Invest Limited has an accounting reference date 31st of March each year. On the 1st of April 2022, the tax written down value of plant and machinery in the main pool was 100,000. Special rate pool was nil. During the year ended 31st of March, Invest Limited purchased new plant and machinery costing 300,000 and new long life assets costing 1.4 million pounds. So their main pool, they've got 100,000 there in their main pool, so they'll get 18% on that. Now, the first year allowance, this new plant and machinery, they'll get 130% of that. Now, the special rate pool, which is the long life assets, firstly, we get AIA, but the expenditure was bigger than the limit of £1 million. So the balance of £400,000 will get 50% first year allowance, super enhanced, and then the balance will be, the remaining balance will attract 6% in the next accounting period. So that's a really good illustration. So go back to the rules, pause the text, go back to the rules, read the rules again, have a look at your illustration to make sure that you completely understand what is happening there. Property income. You should have done that chapter. If you haven't, go back and do it again, please. The manual is in an order in which it means you only have to read these things once. So please, please do them in the order in which they are in the manual. They're there for a reason. It must be on an accruals basis. Rent that has been accrued, allowable deduction, and any lease premium amount that is assessable. And again, lease premium notes you'll find in that chapter. Interest payable on the loan is fully deductible, but not here. There, no. It goes against interest income and not property income under the non-trading loan relationship rules. No rent or room relief. If they make a loss on its properties, it must be set up against total profits before QCDs in the current period. Excessive losses are then carried forward against total profits. You can make partial claims. Now that's unusual. You don't normally be allowed to do that. So you can make partial claims in order to avoid wasting your donations. Now the loan relationship rules. Any interest receivable, this is non-trade. Any interest receivable is on an accruals basis. It will be received gross. Any payable amount goes against trade income if it's for trade. If it's for non-trade purposes, then it's deductible against interest income. So if you see it and it's for trade purposes, then leave it where it is. You don't need to make adjustments in the adjusted profits calculation. If it's not, then all the non-trade loan, the income from loans and the expenses for loans, such as property income, all of those go together. They're all lumped together in what's known as the loan relationship rules. QCDs, they pay theirs gross. Okay, they pay theirs gross, and that goes in the TTP computation. Dividends is the final little bit before we can do a proper question. So dividends received from UK and overseas companies are exempt from corporation tax, never in a TTP calculation. So let's do the first question then in this short chapter. Example number 1, Westmoreland Limited has the following income and outgoings for the year ended the 31st of March 2023. It has tax adjusted trade profits, property income, interest receivable, gains, losses, dividends, QCDs. And we've got to work out the TTP for the year. Okay, so I've got some space at the bottom here. I'm going to do it on here. So again, you must always put a heading in your computation. So this is the 12 months corporation tax computation to the year ended 31st of March 23. So we've got adjusted profits, of 1,456,500, property income $25,000, and interest of $10,000. Now we have gains, but we also have losses, and they needed to be netted off against each other. So we've got 37,500 gains and 2,500 losses, which means we have net gains in the year of 35,000. That gives us a total of 1,526,500 less QCDs, 10,000, giving us 1,516,500 TTP. Oops, TTP. Read the question carefully. Does it want TTP or does it want the corporation tax? If it wants the corporation tax, then you tax that at 19%. If it doesn't, don't do it. If you do it, that's fine. You're just wasting time. Okay. Dividends never included, so I've ignored those. All right, so that's the end of this chapter. A lot of this chapter, apart from the bit at the beginning about the admin side and the 51% and the TTP, the rest of this chapter is all a recap. Okay, if you've not done those extra chapters on adjusted profits, capital allowances, and the gains situations, then property income, 4 chapters, then you need to do that before you progress. And when you have, question 19 and 20.